Accelerant Holdings, trading under the ticker ARX, is one of the more interesting emerging companies in the specialty insurance industry. Unlike a traditional insurance company, Accelerant operates a technology-driven insurance risk exchange that connects specialty insurance underwriters with institutional risk capital providers. The company combines data, technology, underwriting expertise, and capital to improve the way specialty insurance risks are priced, distributed, and managed. The long-term investment thesis is built around rapid premium growth, increasing membership, expanding data advantages, and operating leverage. Accelerant is essentially building an infrastructure platform for the specialty insurance market. Its platform connects insurance, sellers, including specialty underwriting businesses, with buyers, such as institutional risk capital providers. Accelerant provides the technology, data, analytics, and underwriting infrastructure that allow these participants to transact more efficiently. This model gives the company exposure to the growth of specialty insurance without relying entirely on the traditional balance sheet-heavy insurance model. One of the strongest parts of the Accelerant story is its revenue growth. Revenue increased from approximately $344 million in 2023 to $603 million in 2024 and approximately $913 million in 2025. That represents extremely strong expansion over a very short period. Even more encouraging, the company continued to demonstrate strong momentum entering 2026. Quarter 2 2026 revenue reached approximately $356.9 million, representing roughly 63% year-over-year growth. If Accelerant can maintain even a portion of this growth rate over the next several years, it could develop into a significantly larger specialty insurance platform. Revenue is only part of the story. A more important metric for understanding Accelerant's underlying platform growth is exchange written premium. In 2025, exchange written premium reached approximately $4.19 billion, representing around 35% year-over-year growth. This demonstrates that the amount of insurance business flowing through Accelerant's ecosystem is expanding rapidly. Continued growth in written premium can potentially translate into higher platform revenue, greater data accumulation, stronger relationships with capital providers, and increasing network effects. Accelerant's platform benefits from a potentially powerful network effect. By the end of 2025, the company had approximately 280 members, more than 600 specialty insurance products, operations across approximately 22 countries, and around 95 risk capital partners. As more insurance businesses join the platform, Accelerant gains access to more data and insurance activity. More data can improve underwriting and analytics, while a larger network can make the platform more attractive to additional members and capital providers. This creates the potential for a self-reinforcing competitive advantage. Accelerant's reported GAAP profitability requires careful interpretation. The company reported a very large GAAP loss in 2025, but a significant portion of that loss was associated with a large non-cash expense connected to the settlement of profits interest awards around its IPO. Therefore, simply looking at GAAP net income can make the company's underlying operating performance appear considerably weaker than it actually is. Adjusted profitability provides a more useful view of the underlying business. Accelerant generated approximately $237 million of adjusted EBITDA in 2025, while adjusted profitability continued improving during 2026. The 2026 results provide evidence that Accelerant's operating momentum remains strong. During Quarter 1 2026, the company reported approximately $66 million of adjusted EBITDA, with adjusted net income and adjusted EPS showing very strong year-over-year growth. Quarter 2 then delivered another major acceleration, with approximately $356.9 million in revenue and roughly $80 million of net income. The combination of high revenue growth and improving profitability is one of the most attractive aspects of the ARX fundamental story. Another important metric is underwriting performance. Accelerant's gross loss ratio improved from approximately 54.3% in 2024 to 51.3% in 2025, while its net loss ratio improved from approximately 73.8% to 68.4%. Improving loss ratios suggests that the company is maintaining underwriting discipline while expanding the platform. This is particularly important because specialty insurance profitability can deteriorate quickly if companies prioritize premium growth over risk selection. Accelerant's data-driven underwriting approach could therefore become an important competitive advantage. The biggest advantage of Accelerant may be the combination of technology, insurance data, underwriting expertise, and network effects. Traditional specialty insurance markets can be fragmented and inefficient. Accelerant is attempting to create a centralized ecosystem where underwriting businesses and institutional capital can interact more efficiently. As the platform grows, its proprietary data set also becomes more valuable. More historical underwriting and claims data can potentially improve pricing and risk selection, making the platform increasingly difficult for smaller competitors to replicate. Accelerant does not have an unlimited moat, but its competitive position is becoming increasingly interesting. The company has built a growing network of members, capital providers, products, and geographic markets. Reproducing this ecosystem requires more than simply building software. A competitor would need to develop relationships with insurance businesses, attract institutional capital, accumulate underwriting data, establish credibility, and demonstrate consistent risk management capabilities. This combination could provide Accelerant with a meaningful long-term competitive advantage. Insurance companies must always be evaluated through the lens of risk management. Accelerant has historically used substantial reinsurance to reduce its exposure to insurance losses. This helps protect the company from catastrophic underwriting outcomes, although it also means that Accelerant does not retain the full economics of every premium written through its ecosystem. The reinsurance strategy can make the business more resilient, but investors should continue monitoring capital requirements, reinsurance costs, loss ratios, and reserve development. The first major risk is the specialty insurance cycle. Insurance pricing can change significantly depending on competition, claims activity, catastrophe losses, and available capital. If insurance pricing becomes too competitive, Accelerant's premium growth could slow and underwriting margins could come under pressure. The company's technology and data advantages can help, but they cannot completely eliminate the cyclical nature of the insurance industry. The second major risk is unexpected insurance losses. Specialty insurance can involve complex and sometimes highly unpredictable risks. A series of large claims or catastrophic events could negatively affect underwriting results. Reinsurance provides an important layer of protection, but it does not completely eliminate the economic impact of major losses. Investors therefore need to monitor loss ratios and reserve trends rather than focusing only on revenue growth. Accelerant's valuation is heavily dependent on continued growth. A company growing revenue at 30% to 50% annually can potentially justify a premium valuation, but if growth suddenly falls toward the low teens, the market could significantly reduce the valuation multiple. This means ARX has both business risk and valuation risk. The company needs to continue expanding its exchange, members, written premium, and profitability to support a premium market valuation. For 2026, my base case view is that Accelerant should continue producing strong double-digit growth. I would not assume that the extraordinary 63% Q2 revenue growth rate continues indefinitely, because doing so would create an overly aggressive forecast. Instead, a more reasonable framework would assume approximately 25% to 35% revenue growth under a base case, with potentially higher growth if membership, premium volume, and capital participation accelerate. Improving operating leverage could allow EBITDA to grow faster than revenue. Looking toward 2027, the most important question is whether Accelerant can transition from a rapidly growing insurance platform into a consistently high-margin insurance infrastructure business. Under a successful scenario, revenue could continue growing at a high teens to low 30% rate, while adjusted EBITDA grows faster because of operating leverage. If the company can simultaneously maintain underwriting discipline and expand its network, the market could assign a higher valuation multiple to the business. In my bear case, specialty insurance conditions weaken, premium growth slows significantly, underwriting margins deteriorate, and the company's operating leverage fails to develop as expected. Under this scenario, I would value Accelerant much more conservatively, with a potential standalone valuation around $16 to $18 per share. The major issue in this scenario would not necessarily be that the company becomes fundamentally broken, but rather that the market stops rewarding it with a premium growth multiple. In my base case, Accelerant continues growing its insurance platform at a strong double-digit rate, maintains improving underwriting economics, expands adjusted EBITDA margins, and continues adding members and capital partners. Under these assumptions, I estimate a potential standalone 2027 fair value of approximately $23 to $27 per share. This would represent a successful execution scenario without requiring extremely aggressive assumptions. In my bull case, Accelerant becomes one of the leading technology and data platforms in specialty insurance. Exchange written premium continues growing rapidly, membership expands significantly, underwriting remains disciplined, and EBITDA margins improve faster than expected. Under this scenario, a standalone valuation above $30 per share could become achievable. The bull case depends on Accelerant successfully turning its growing network and proprietary data into a durable competitive moat. I would not value Accelerant purely on traditional price-to-earnings metrics, because its accounting history has been affected by significant IPO-related non-cash expenses. A better framework is to consider enterprise value to adjusted EBITDA, revenue growth, exchange written premium growth, free cash flow potential, and the quality of the company's insurance platform. If adjusted EBITDA reaches approximately $350 million and receives a 10 times multiple, the implied enterprise value would be around $3.5 billion. At $400 million of EBITDA and a 12 times multiple, the implied value would rise to approximately $4.8 billion. There is now an extremely important development for ARX shareholders. Thoma Bravo has agreed to acquire Accelerant for approximately $20.25 per share in cash. This significantly changes the investment thesis. Instead of simply asking what ARX could be worth in 2027, investors now need to consider the probability that the transaction closes and whether the standalone value would have been higher. If the acquisition closes at $20.25, shareholders would receive cash rather than participate in the company's potential future upside as a public company. The acquisition is particularly interesting because my standalone base case valuation is above the announced acquisition price. If Accelerant successfully executes its long-term growth strategy, the business could potentially be worth more than $20.25 per share as an independent company. However, shareholders also face transaction risk, timing risk, and the possibility that the deal does not close under the expected conditions. Therefore, the current ARX investment decision is no longer simply a conventional growth stock decision. For a standalone scenario, my 2026 framework would place fair value around $20 to $24 per share, depending on the final earnings trajectory and market valuation multiple. The announced $20.25 per share acquisition price therefore sits close to the lower to middle portion of my estimated standalone valuation range. However, because of the acquisition agreement, the market price should increasingly reflect deal expectations rather than purely fundamental growth expectations. For 2027, my standalone base case target is approximately $25 per share, with a reasonable range of $23 to $27. The bear case would be around $16 to $18, while the bull case could exceed $30 if Accelerant achieves stronger than expected growth and margin expansion. These are hypothetical standalone valuations and should not be interpreted as a prediction that RX will actually trade at those prices given the pending acquisition. My fundamental rating for Accelerant Holdings is BUY from a long-term standalone business perspective, because the company has strong revenue growth, rapidly expanding insurance volume, improving underwriting economics, a growing member network, and a potentially valuable technology/data moat. However, under the current acquisition situation, I would rate the publicly traded stock as hold. The investment thesis has shifted from pure growth investing toward evaluating the $20.25 acquisition price and the probability of completion. Overall, Accelerant Holdings is one of the more compelling specialty insurance technology stories in the market. The company's combination of insurance expertise, technology, data, capital connectivity, and network effects gives it significant long-term potential. The biggest concern is not the underlying business quality. It is the fact that the Thoma Bravo acquisition at approximately $20.25 per share could prevent public market investors from capturing the full long-term upside. If ARX were still an independent public company with no acquisition agreement, I would have a more clearly bullish view and would consider the stock a strong long-term growth opportunity. Under the current circumstances, however, fundamentally bullish. Standalone 2027 potential, $23 to $27 base case, $30 plus bull case. Current investment stance, holder deal dependent.